The US dollar is more than just America's currency. It's the backbone of the global financial system. From international trade and commodity pricing to investment flows and central bank reserves, the strength of the US dollar affects markets all over the world. For global investors, understanding why the dollar moves and how its strength impacts assets is essential for making smarter investment decisions. At its core, the US dollar is the world's primary reserve currency. Governments, corporations, and financial institutions use it to settle trade, issue debt, and store value. When the dollar strengthens, it sends ripple effects through global markets, influencing everything from stock prices to emerging market economies. One major reason the dollar's strength matters is its relationship with interest rates. When U.S. interest rates rise or are expected to remain higher than those in other countries, global capital often flows into dollar-denominated assets. Investors seek higher yields and perceived safety, increasing demand for the dollar and pushing its value higher. This process is heavily influenced by monetary policy decisions made by the Federal Reserve. When the Fed tightens policy to fight inflation, the dollar often strengthens as borrowing costs rise and returns on U.S. assets become more attractive compared to those elsewhere in the world. A strong dollar has a direct impact on global trade. Since many international transactions are priced in dollars, a stronger dollar makes imports cheaper for U.S. consumers but more expensive for foreign buyers. For global companies that rely on exports to the U.S., dollar strength can reduce demand and pressure profits. Commodities are another area strongly affected by the dollar. Oil, gold, and most raw materials are priced in U.S. dollars. When the dollar rises, commodities become more expensive for non-U.S. buyers. This can reduce demand and push prices lower, which is why commodity markets often move inversely to the dollar. For global investors, currency risk becomes especially important during periods of dollar strength. Investors holding international stocks or bonds may see gains in local markets offset by currency losses when converted back into dollars. Emerging markets are particularly sensitive to a strong U.S. dollar. Many emerging economies borrow in dollars, meaning a stronger dollar increases the cost of servicing their debt. This can strain government finances, weaken currencies, and sometimes lead to capital outflows or financial instability. In conclusion, the strength of the U.S. dollar matters deeply to global investors because it influences trade, commodities, capital flows, emerging markets, and portfolio returns. Understanding dollar dynamics helps investors manage risk, identify opportunities, and navigate an increasingly interconnected global market.